Good day, and welcome to John B. Levy and Company. This is the first in an occasional series of podcasts where we intend to chat about new trends and conditions in the commercial real estate and investment market. And we're quite excited about this and very much interested in your feedback and your thoughts. Today's topic is real estate finance. As we look at things, we think the market is saying 4 words. It's the end of free money. And for those of you that haven't been in the market recently, I think you'll notice that risk has really been repriced. And it's been repriced only one way, higher. In fact, we're in the middle of what most of us would call a full-blown credit crunch. And along with that comes lots of volatility. Let me give you an example. In June of this year, the 10-year Treasury was 5.2%. And in fact, I felt fairly vindicated because the 10-year Treasury finally went above 5%, which certainly I'd been predicting for several years. But it wasn't to stay there long. This month, the 10-year Treasury is no longer 5.2%, but is 4.35%. We've seen that volatility before, and in fact, the comparison that comes to mind most quickly is the comparison between now and 1998, when we had the Russian debt crisis and the crisis with long-term capital management. If you've been on the beach or on vacation for most of the summer, you've come back to a reality that says the market that we're in now doesn't bear any resemblance to the market you left. Let me give you several examples. For example, the 10-year, on 10-year paper, 10 years of interest only, absolutely gone. In fact, you may well fight to get 3 years of interest only, followed by an amortization schedule. Coverages are up. What you thought might have been a 1.15 coverage times interest only is now more likely to be 1.2 times an amortizing constant. So coverages are up dramatically. Number 3, spreads have just gapped out. For example, before you left, spreads on commercial mortgages on the fixed rate side, probably 100, 110 over treasuries. Now, you'll find that spreads vary a lot more, probably 175 to 225 basis points over treasuries. And if you're on the floating rate side of the market rather than the fixed rate side, the changes are even more severe, because not only have floating rate spreads gone up, but the index, LIBOR, has gone up as well, whereas on the fixed rate side, spreads have gone up, but the treasury yield has gone down. Cap rates, we're finding, are sticky, which is another way of saying that they haven't gone up as much as we might have expected. In at least the intermediate term, we wouldn't be surprised to see cap rates increase somewhere between 25 to 50 basis points, depending on location and property type. One thing's for sure, cap rates are not going down. And leverage is down. Let me give you an example. Mezzanine debt, which before your vacation, readily available at 90, 95% loan to value. Now you'll be lucky to get mezzanine debt at 85% loan to value. And in addition to that indignity, you'll pay more for it. In our next section, we will talk about what to do in the middle of a credit crunch to keep you actively involved in new transactions and moving forward. Please join us. In the future, if you'd like to be notified when we have new podcasts, please sign up on our website and we will send you an email when it's launched. Thanks.